Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you for joining me. Well, Friday was a very volatile session after the US dollar extends its bull run from Thursday's low around 100.70 and surges on Friday from 101.35 to 102.80 and settled there in New York after a surprisingly stunning US job report, which has fueled renewed concerns that the US Federal Reserve may remain aggressive in its path of interest rate hikes, even though inflation has been steadily cooling. The blockbuster US jobs report Friday triggered much panic as the investors try to recalibrate the expectations on how long the US Federal Reserve hawkish path will need to continue in its quest to fight high inflation. Beating the forecast of 193,000 market estimate, that is, the US economy added 517,000 new jobs in January, while the unemployment rate still remains around a 53.5-year low of 3.4%. It is assessed that the aggressive bout of rate rises from the US in 40 years will likely continue towards the benchmark around 5%, so that it can continue to squeeze high inflation out of the economy. In other signs of economic strength, US services industry activity rebounded strongly in January. So as we look at the market now, we can see that the Australian dollar bearish divergence kicked in very aggressively and crushes the level of 69.90 and now exposes the 60-day moving average around 68 figure 20. Technicals are still somewhat negative and therefore keeping an eye on this ADX in case the bear strength increases ahead of the RBA when it's expected to deliver its quarter-point interest rate hike on Tuesday. No doubt it will be all eyes on the statement to see if the RBA has turned dovish from the expected rate hike or remain hawkish. Looking at the technicals, as I mentioned, the bears are coming in, so no doubt any upside attempt should be capped around 69.55 on the day. The euro, with the market since reaching the top side target around 109.45.65 last week and extended up to 110.40, it's plummeted and now looking back towards the region of 107.40.50. In light of the pattern, the bears are still very much gathering and therefore could weigh on this level and expose to the downside target around 106.20 and reassess. The dollar yen, having consolidated for some period, displays a very strong candle and rallies strong into Friday's session and now looks towards the region of 132.80.90 as a potential target. Any pullback is likely to be shallow and could see the support coming in minor around 131.45 and then maybe even see more gains following on from there. Sterling was also heavily into the Friday session as the now ADX is trending to a bear case, but we are a little bit oversold. Nevertheless, from the technical pattern, the market can actually extend its downside move to 119.55 and then reassess. As we can see, gold, after rejecting that top side and posting a key reversal, got confirmation and now reaches its objective, which is seen at 1,860.65. In light of the pattern, keep an eye on this level at 60 because if it does break, then it will expose further downside slide towards 1,820.26. Any upside attempts sees an intraday cap around 1,870. Wrap it up with oil, but the market crushes supports all through the last 3 days. And now from Friday's close, reaches his next objective, which is at $73 a barrel. I'm not bearish from this region due to the fact is that from anywhere of 71 to about 73, there was bullish activity and may again see this. So therefore could give opportunity if the bulls are lurking and maybe see a bounce anywhere from 71, as I mentioned, to about 72.5. Well, that wraps it for the morning. Thank you very much for joining me. And as always, look out for the interest rate report. I hope you enjoy the great start to the new week.